Okay, session's being recorded. Good morning. It's October 9th, 2016. This is Clueless A Trading Frank. We have great members today. Good crowd here. We have Corey, we have Jules, we have Nia, we have Seashell, we have Vic, Van Ter, and I'm sure some others will be slipping in when they have time on this rainy and somewhat soggy Sunday morning here on the Jersey City waterfront. Okay. Full disclosure, this is purely for financial education and not for any solicitation or advice. Session will be recorded and uploaded for free. This is open to everyone. Just wanted to make it open to everyone given the fact that we're entering, we always enter a critical phase on a Monday, right? It's nothing new, and I've come to accept that, that particular truth. But more so now that we're entering the stretch of October, which is considered to be the, not considered to be, on a factual basis, is one of the most volatile months, but not to mention the fact that the volatility throughout the past year and a half, if not the past 6 months, has been intense. So so I wanted to open it up to everyone so everyone can hear what some of the things are, some of the questions that we'll answer and things like that. The session will be uploaded to the Clueless A Trading YouTube channel and anyone can access it. Purpose of today's session is to look at a pretty broader view on what's going on, discuss a little bit the challenges that we face every single day in trading, and that applies to all of us, including me, of course, and then how to minimize some of those challenges and make the best out of it. There's no single way of doing it. We know that. But there are ways to minimize some of the mental stress that we go through if we have too large a position on one side or another, and then we get caught, and no fault of ours, and we know that. It's never a fault of the person per se if they are in a position that is looking from a technical perspective solid, and then it just not working. That's nobody's fault. I think the blame lies when some of us don't take any positions, and then we let things just fly out, whether it's on the short side or the long side, and we sit there going, oh boy, I can't, missed it again, because that missing it again does have a mental degradation, I would say, because it eats away our confidence in saying, okay, what am I going to do with the next trade? So saying all that, we are all, from what I can see, working hard. And again, I'm no preacher, and I'll tell you, I think we're all working very hard to work through the mental challenges that we face every day. And I see a lot of people who originally were this keeps on doing that. Originally were very suspicious about volatility, starting to embrace it. And I think that validates and makes me as a person and as somebody who is a founder and trader at Clueless A Trading happy, because I think I'm achieving something. Because there's the same things that I mentioned to people, just so you all know, and I'm sure many of you know very well. I apply to myself. It's not like some BS thing where I'm like the guru, I know everything and I'm doing everything right and all that stuff. I'm screaming at myself the same way, and trying to mentally motivate myself during difficult times and during easy times. So, and I'm sharing that with other people. So never take it the wrong way when I'm out there, doing my motivational recalibration, mental recalibration, because believe it, that's exactly how I pressure myself too. So good. And then that's, just wanted to make that clear. It's not reserved for, just for members and stuff. So let's get into the technicals of what's going on. We're entering October. I told you before, sticking by it somewhat, that the first week in October, generally speaking, or any month for that matter, is where you have new pension inflow of pension fund money, institutional fixed money, I would say, not fixed income, and monies that come into, checks are being deducted for all kinds of, 401ks and other retirement plans, and that money has to go somewhere. And when pension fund managers and large TIAA, CREF, and CalPERS, the largest one, California Retirement Pension Fund, all that stuff, put money, and even when they're cautious about the market, they still have to, under their mandate, just so you know, and the Fidelities and the Putnam Investments, my first, the entry into the financial world at the college. So Putnam Investments, they run big, large endowments and retirement funds. So they have to put some money in the market. So that generally goes in, just so you know, the first part of the month, regardless of what happens. So saying all that, it doesn't minimize volatility, mind you, because there's a lot of macro factors that's happening coming from internal as well as overseas, which we know, and we're going to mention that too, that are rocking the markets. So those pension funds obviously are trying to pick and choose. Okay, I'm going to get into this here. I'm going to keep on Amazon till it reaches 3,000. I mean, just kidding, but seriously, if you think about it. And then I'm going to keep on pushing Priceline, even though the calls are like getting a mortgage and buying into them, all that good stuff. So they select things that they keep on going into regardless of anything. And then, of course, selectively they go into different types of stock. That's the simple reason, just so you know. In between that and what the machines are doing constantly, the algorithmic high-frequency trading programs, which have many different styles, by the way, creating intense volatility based on economic factors that are coming. The crash of the British pound, and believe me, that was a crash at 3 a.m. in the morning. I must be really like tuned in with the market, because I blinked my eye. It was like 3:05. It was what? It was Thursday, and I look at the thing here, and I got all these things set up on my iPhone, and I see this massive fall on the British pound, sending me an alert. I'm not a currency trader. I just follow them as proxies. And it's just like, wow. So all that stuff comes in. The machines, by the way, don't make the rules, just so you all understand. They amplify the movements, right? They're based, most of the algos and HFT programs out there, black boxes, are trend amplifiers. Okay, so let's say, for example, little move happens here. They'll come in and just jam it, take out the stops, the triggers, and then bang, 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 fall. And then on the upside, they do the same thing. Look what happened on Friday. So what I try to do, to my best, and I know a lot of you know that, but it's important for a lot of new people who'll be hearing this to understand, is I try to basically read as much as I can off the technical algorithmic tea leaves, using whatever tools in my hand, whether it be the quad programs, whether it be Think or Swim, whether it be all the different indicators I'm following in the market, and finally the two brain cells that are left in my head, right? So trying to analyze that and going in front of you all and saying, hey, I think this is it. And of course, some signals are very direct, but they might last 5 minutes. We know that. A green candle can disappear, whoosh, in nanosecond. So therein lies volatility. So what happens sometimes is people want, a lot of people do, and human beings are geared towards that, they always want straight answers, right? They want to say, hey, are we going up or are we going down? I want straight answers, for God's sakes. Make my trading and life a lot simpler. But it's never a straightforward answer. There are so many multiple signals. And I'm kind of setting you guys up so that when we talk about these things here, you'll understand that it's not a black and white situation. It's a lot of grays and a lot of other different hues of colors that are coming through, right? So everyone wants a straight answer. So sometimes in the heat of battle, when I'm managing my trades, I'm putting stuff out there. In a way, I'm kind of ditto trading, even though you're not mimicking my exact book, but I'm kind of walking people through all this kind of maze of volatility. And believe me, there's no textbook in the world that can say, oh, this is a real pattern. I'm talking this move here. Okay, this is not a pattern. This is a pure, unadulterated, the new normal volatility. In between, we can detect patterns. So coming back to it during the day, so that we're prepared as we move forward, is when a lot of simple, direct forward answers, questions are asked. They're all good. They're all good. But it is almost next to impossible for me to answer, because what I'm doing is I am fine-tuning all my work and delivering a suggestion or a forecast based on what I'm seeing in front of me. It doesn't mean that it's going to basically for the next day or so be there. My forecasts on intraday are extremely accurate, even through the most difficult times. Patience is required, obviously, as we all know. We're starting to defer to Mr. Slow Stow, as I like to call it. Okay, it's become a meme, right, Mr. Slow Stow? And once once the slow stochastics start turning, we generally get a trend amplification run by the algos. That makes sense to everyone, what I'm saying?
Yes.
Okay, so when it starts to turn, oh, by the way, happy Thanksgiving, Canadian Thanksgiving. I actually tweeted out, not tweeted, I sent a BlackBerry messenger to my brother-in-law up in Canada, my sister-in-law. He's still a BlackBerry user. They're very loyal to their phones, right? Well, he comes from the same town as BlackBerry was born, which is Waterloo. Silicon Valley of Canada, by the way. And so happy Thanksgiving to Nia and anyone else who's up there in the beautiful north. All right. So what happens is when I'm seeing these trend movements, right, coming through, and you can see that as you zoom in. And it's right there, right? What time was it? Look at the bottom is like 11, and then 12 o'clock, 1, 2, yeah. So right there, I can make that call here, and like we did, and things went up like 40, 50, 60, 70%. Fast traders, active traders. Now, once it hits certain trend line, this is a simple chart, right? The more complicated ones are the ones where we're reading multiple movements and stuff, pivots and everything like that, which is extremely key. So right there, we almost close into the pivot, the 215.52 level, if I remember correctly, on the SPYs, and bang, it doesn't go anymore. So point is that, yes, I can call this move, which will last maybe half an hour, make a decent sum of money, don't have to go crazy, make a decent sum of money on a small amount of money. And like many of you did, like I lost the last round of the SPX, did extremely well in the first 2 SPX trades, and gave back about 30% of those profits on the last one because I wasn't quick enough. Basically it. But it's not just I wasn't quick enough. I said, hey, let me take the chance. The last half an hour. If it goes, it goes. If it doesn't go, out. So fine. So the last one was a good solid like 70% loss by the time all said and done. But the first one's solid moves. It's a net green. However, that's active trading. Now, saying all this, when you look at a pattern like this, there's no way of me telling whether or not on Monday we're going to get to the upper end of the Bollingers, which seems the logical technical move. And why do I say that? Because every single time, whether we're moving into pinch Bollingers, whether we're moving into these type of very large type of stretched Bollingers, I'm going to talk about Bollingers for a second in a few minutes, because it's important for people, they're traders who trade off Bollingers, believe it or not. And this is not frozen. Okay, good. And so the logical move says, okay, we're going to get to the top of the Bollinger, which is around 2157 on the E-minis, which translates into, no, this is the SPX. Okay. Let me see. Where did the SPX close at? Closed at 2153. Nope, this is the E-minis because it shows 2146. That means the SPX closed at 2156. I'm sorry. You always add like a couple of extra points, mostly about 7 points or so to your E-minis, okay, in order to arrive at the SPX figure. So automatically calibrate yourself to think like that. So 2146 on the E-minis, add 7 to it, 7 points to it, 2153. That's basically what, what the closing was on Friday, 4 o'clock. So let me get back to my chain of thought. All right. So bottom line is that there are no easy answers in a volatility market because volatility in itself, and people who are, somewhat sort of math orientated know that very well, that it's not just the change itself, but the rate of change, as what that's the basis of calculus, and algorithmic programs and stuff are looking at not the exact points, but they're looking at how fast and they can make money by exaggerating that rate of change. So when you see and again, I'm not talking about the economic backdrop and stuff. There's always a reason why something happens, but the something doesn't happen because of that reason. It starts happening, and then the news comes out saying, hey, that's why, and everyone says, oh yeah, maybe that's why we went down. So, but the news is simply the noise that is used to justify movements in the market. Just always remember that. I'm not saying bad news doesn't drop markets. I'm simply saying that markets start to give signals, technical signals, prior to that news coming out. So anyway, so saying all that, when you see a movement like this, for example, which we see almost every day, we saw it here, right? We saw it. Oh, it gives you. Look at this. This is investing.com. It actually tells you the actual, that's a bearish reversal or a bearish engulfing, which bottomed out here, and then this is Friday. This is a Friday alone. So anyway, so when this first block starts coming in, then the second block starts coming in. You get an acceleration, or the rate of change, or the speed of the drop. Not because the news is getting worse. It's because the algos will amplify this move, get everyone out, and that's where these internal readings come in so important. And everyone says, oh my God, this is it, it's over. Because that's the normal mental, human feeling, right? This is it. I mean, look at look at this drop here. This drop alone was a couple of 100 points, right? It wasn't that long ago. It was the 4th of October. Now, I kept on saying that this was very similar to the 4th of October, and so far I'm very correct. You had very large bars, which are similar in size to what happened on the 4th of October, and then we got the reversal. And then the next Monday, on the 6th, okay, this was the weekend, and then on the 6th, it basically took off like a rocket. And on Monday, it took off like a rocket. So is it possible that this pattern gets revealed here? Replicated? Absolutely. Absolutely. So what I'm getting at is the volatility itself inherently is very, very difficult to decipher. And short-term forecasts are, unless one is an active trader, and make money off the short-term volatility, don't attempt it. Sit out. Sometimes you don't need to trade. Like we all know, cash is an asset. Sit there. It's tempting as a trader, very difficult as a trader to say, okay, I'm going to sit there and let the market pass me by. Oh, I could have made money there. I could have made money there on the short and long side. But sometimes just sit back. Just don't do anything. I'm not asking you to do that, but I'm just saying sometimes that's a great strategy. Or sit on some nice swing setups and just say, you know what? Yeah, I might be down on this, but look, it's looking good. This is what I always wanted to buy. Sit there and do what you need to do. P&L doesn't have to be green every single day. And believe me when I tell you, the biggest profits in all your books will come as a trader, where you set up trades, could be read for a day or 2 days, and then you make tons of money. And we've been doing this for a while now, over the following day or two when that reversal bounce comes. So saying all that, let me get into each of the charts at a time. So this is what the not longer term, there's nothing. This is what the chart on investing.com looks like. I'm using this platform more and more quickly, especially on my iPhone when I'm off my trading desk and stuff, and also during the day. And I'll tell you, it's a pretty damn, for on the free investing.com, and you can download that app directly on your iPhone. Oh, by the way, I just got my iPhone 7 Plus on Friday. Came from nowhere, and it was supposed to come at the end of the month. So maybe that's good news for Apple, that they're actually shipping these things faster than what is the shipping date. So saying all that, my charts are there. You guys can replicate it or look at it or do whatever you need to do with it, every day when I'm putting them out. So when I'm looking at these things here, there is a floor here at 2135. That's roughly about 2140 on the S&P. So that's pretty defined, because that's a very strong level of support. Volatility charts have to be analyzed very differently than any other charts, period. The old-fashioned way of simply looking at, okay, here's a head, here's a shoulder, that's all fine and good. But in between that head and shoulder patterns, there's a lot of inverse dragon bullish, inverted head and shoulders, wedges, all kinds of stuff. So you can't just make a random determination, okay, it's a head and shoulder, we're definitely going down. If that's the case, I'll just buy $20,000 worth of SPX puts and then take out $200,000 in 5-10 days. Let me know when I can do that, right? I mean, I would love to do it, but it's tricky. That's what I'm getting at. So saying all that, this is a major level of support. Keep on talking about, keeping on seeing myself. And and we want to respect that. Once it breaks that, the next level that comes into play very clearly is this one, right? And that one brings us down to what I consider to be, and not just me, I'm no guru, there are big shots out there, they say the same thing, which is pretty visible in our charts, which is the 2120 level or so on the S&P. So it's slightly lower actually, but anyway, 2122 on the E-minis is 2127 on the SPX. So somewhere between 2120 and 2125, that's when the, you know what, hits the fan. And media plays a big role in creating panic. And especially on the panic side, that's what. Remember, misery and fear sells a lot bigger than happiness and euphoria. Believe me when I tell you. You guys all know that too. All right, that's life. Bad news makes news, right? And good news very seldom makes news. So bottom line is the same thing with the markets. So looking at it from a pattern of where we are, once you break that, you're looking at here. So this is what I'm thinking might happen as we get towards the middle of October, which is this week. I don't know the reasons. There are many different reasons. There are good reasons. There are bad reasons, right? So this pattern here, I'll try to move my mouse. Hold on. To me, makes logical sense from the bearish side, and this is just one view, that once this pattern is completed, somewhere around the 2100 level, remember this? I mean, that's like when the bungee cord breaks, right? But you fall into the water and you live, and that's why the markets rose. So saying all that, this was back on back in September, right? August? I can't remember. September actually, first week in September. So because this is October, and so back then, so you had that huge fall. So and then the market basically rose. Now using the pitchfork, Andrew's pitchfork, you know, it kind of puts things in perspective a little bit, and that's why I put these channels here. Here's a big downtrend line, the 2165 level or so on the SPX. If we manage to break above that, there's going to be a pretty powerful squeeze, just purely for technical reasons. And that squeeze is going to bring us all the way up into that 2184 E-minis, which is 2190 on the SPX, which is the retest of the ATH or all-time high. And it's going to happen very fast and very furious because there's nothing here other than this minor resistance for it to go. Yes, we'll probably find resistance around the 2180 level or 2177 level on the SPX that I've talked about extensively. But once this breaks out, you are talking about a very convoluted, complex, but volatility defined, not your regular stuff. Like one of our new members said, you know what, it doesn't look as defined as it does when I said in the real battle. MJ mentioned that actually, which I think was a great point. That in the real world of algorithmic trading, they will never make patterns as defined and easy to read as you would when we do the webinars or when we draw, you know, when we study technical patterns and stuff. A double bottom very seldom looks like a double bottom in trading. A double bottom can look like this. So you have to somehow make a determination that's a double bottom looking at many different facets of technical analysis, including internals and all that stuff. So the same thing here. If this happens, okay, if this happens and we break out over this, then it's a pretty good run up that we are going to basically create that big multiple dragon bullish formation, find a major support level, resistance here, and if we break out over that, we're going to pretty much break loose. Now saying all that, the really bullish scenario, which I am not at this point subscribing to in a big way because of elections, because of all the stuff happening with the British pound, what's happening with a possible rate hike as early, believe it or not, as November. There's talk that they might, you know, forget the election cycle and all that and just say, okay, the economy's stronger enough, we're going to raise in November. That was one of the fears in the market too. Not that the markets won't jump after the rates are hiked. The markets always get scared before the rate hike, and then they jump right after that, and then we see what we need to do. So when Fed Stanley Fischer comes out and says, hey, everything is looking like it's shaping up, it's a Goldilocks scenario, read in between the lines. He's basically saying we are ready to raise rates. That's why Goldman Sachs bumped up big time, right? Look at that stock. It's like jumping jelly beans here. It just wants to go up, go to 170. Where did GS close at? Let me just check 1 second. GS closed at 169. It's right there. It's probably going to 175. They want to see rate hikes. So saying all that, that's where we stand here. Now, God forbid things, this Andrews pitchfork, by the way, is a pretty damn good indicator. I drew it from these previous things, but let me show you a situation like this. So this is more relevant to where we are, right? There you go. And take this. I always found this to be a very stylish indicator, if that makes any sense. Okay, there you go. That's much better. So what this is telling us, that we are close to entering. And remember, my technical analysis looks at so many different things, but I do it my own way. Some, maybe somebody won't describe it the same way. But look at this channel here. If we jump back into this channel, purely from channel study tells us that in order for us to enter the second channel, these are it would be extremely bullish formations. If we go here, vacillate around there, and then break out of this channel, then the next channel entry becomes pretty much of a high probability trade. Remember, the second channel on the Andrews pitchfork is blue skies all the way up to 2200, pretty much. All right. So saying all that, this was the previous high going back. This was the previous high. So if we break out into the second channel, this is channel number 2. We're trading in a heavy volatile range within channel number 1. When you put this in perspective like this, it doesn't seem that odd, right? Makes it difficult trading, but it doesn't seem that odd. Here's channel 1, channel 2, channel 3, and channel 4. Okay, my longer term forecast, if I dare to make one, is by end of the year we are looking at here, because whether Trump wins or Clinton wins, you are going to see a post-election drop and then a severe bounce, because both of them are going to inject immediately, at least in words from their bully pulpits as the next president of the United States of America, about how much money they're going to spend in building infrastructure and you name it. Trump's plan is more in infrastructure. Clinton's plan also has, but Trump's plan basically has much more money towards airports, bridges, trains, subways, you name it. Okay? So bottom line is, the minute that, the markets love that. Markets love spending. They might tell you they like deficit control and it's all BS. Markets love government spending, whether you like it or not. Okay, that's a reality of the thing. And that's why, whether we like to hear it or not, markets generally, historically, just historical stuff, tend, in fact, have performed the best under Democratic administrations. And that's a fact. It doesn't make the Democrats better at social issues or this and that, Republican. I'm just basically stating a fact based on, years. So bottom line is, the funny thing is, stock markets, and I come from the background of Wall Street, so I'm telling you the bottom line, do not like heavy-duty government cuts. They like cuts. They don't want runaway, out of control stuff. But in general, stock markets love government spending. Don't let anyone lie to you about that. They love when governments spend money to boost infrastructure and stuff, which I think is fine. Infrastructure has to be removed. Look how old our airports are. I mean, sound like Trumpy. It's disgusting. It is, honestly. There was another minor rail derailment on the Long Island Railroad. Thank God no one was, no fatalities, but people injured. I mean, there's a lot of stuff going on. So we do need a big infrastructure push in our economy. No question about that. So anyway, so coming back to the technicals of this thing here, this chart is going to be very useful. I'll be using that a lot more. going into next week. Because if we stay within this range here, this channel, okay, and frustrate the crap out of everyone else out there, we at least are making head or tail of what's going on. Look at the media, or other people out there on different forums and stock twits or any other, they're like lost, like they just don't know what the hell the market is doing. We at least have a pattern of what's going on, volatility pattern. So if we break out over this, watch out. You're going to move real fast and furious, and that would be a bullish breakout. But before that happens, expect this sideways volatility to continue. So how do traders manage that? They just have to manage it the way we're managing it. We're keeping trades closer to the vest. Do not put too much when you're trading the indices or even individual stock, because this waves of selling and buying that come in are not something that you can define on a binary basis. In other words, just because something's going up a little bit doesn't mean that continuation is going to continue. Next day you wake up, bang, it's down $5. Why? No other reason. Selling coming out of Europe, currency wars, currency flash crashes, what do you call, maybe some news out of Germany, maybe some stuff coming out of here, some federal governor basically making some comment. So just keep things even keel. Don't have to go nuts at this time. Lower positions in the market and hopefully make more with the stuff that you have. But you put too much in there, I can assure you, you might have had a good week or a bad week or whatever the case may be, but it is going to be very difficult for you to manage that. So if it requires that every night you take down your trading positions in cash, do it. Nothing wrong with that. I mean, I sometimes, I don't go completely in cash, but I'll always leave a little bit of the SPX stuff or RUT stuff out there, whether it be on the long side or the short side. All right. So that's it. You don't want to put too much because you know how those things move. You might even have, let's say 4, and you would be down a couple of grand for no reason other than volatility. I'm talking about the SPX or RUT options, right? We know that. You can have 2. You could be down, if they're expensive, then you'd be down a couple of grand. So you want to do whatever you think is comfortable so that you wake up in the morning and not like freak out because futures are down 15, or if you're short, they're up 15, right? Those are not good things to do. So these channels are going to be extremely important. Is that clear with everyone on this particular chart?
Yes.
Okay, so very defined, 250, 270, channel-wise, 290. It's funny how they move in increments of 10 and 20, right? You can notice here, and I don't draw these channels, right? I just put the basic default Andrews pitchfork on this chart and try to make head or tail out of it. Excuse me. So the second channel here is obviously, as you can see, is wider, believe it or not, wider, 270 to 290. This is this one is 252 to this, yeah, kind of similar, 18 points, 20 points, whichever the case. That's the level that the market's moving in. And when we revisit this chart every week, we'll see where we stand. Now, if on the downside, I've mentioned to 2135, 2120, and then a complete pattern symmetry would be down towards the 2100. If we get a big fat move like this down, we could actually get to 2100 pretty fast. This pattern itself is let me just show you the bigger picture, is a big head, multiple right shoulders, and the left shoulders are basically down here, believe it or not. There's no comparable left shoulder other than here. So anything break over the right shoulders, these multiple convoluted right shoulders, is what's going to create the big move. And anything below and in between here, these are all, in between here, these are all head and shoulders, negative. Okay, so these are 2 major head and shoulders, 3 of them. In the meantime, a bull will say, hey, hold on a minute. What are you going to show me the head and shoulders? They say, what are you showing me the head and shoulders, man? Show me the inverse head and shoulders. So that's what we would do by looking at inverse head and shoulders. This is a dragon bullish pattern with a head here, left shoulder, multiple right shoulders, breakouts, and then see you later again. Then another. Let's look at this one here. You got a head, You got a left shoulder, multiple right shoulders, another one creating a head, possible left. This is, again, the previous right shoulder becomes the left shoulder, right? Just the way it works. Just the way supports become resistances, shoulders become right or left. So now we got to hold somewhere around here, or maybe slip a little bit to create the right shoulder, and they'll say, hey, we're going to get one of these. We got it here, we got it here, why can't we get it there? I say, hey, let's see. Whether we do it or not. Mr. Stowe is telling us that he wants to get overbought again, so maybe we get a little bit of a ramp till he gets overbought. That's on the other screen. Posted that at the end of the day for everyone to see, right? To take a quick peek at it on, let me see here if I can open it up on my other screen. Okay, I did. So let me match this chart in with this one. Let's get all these yellow lines out of here. Beautiful. So when we look at this here, we see, so looking at this chart here is showing you the overall pattern volatility movements, right? Good stuff. Now you want to get a little bit in deeper, and that's why I mix and match a lot of stuff. So here is your the 1 hour SPYs. Look at this. Pattern's good. Based on previous patterns. So this is so much more defined, right? For tactical traders, beautiful. That's why I say try Quad out. Call them up. They're an independent company. They supply to Wall Street and a lot of hedge funds and stuff. Great guys. Try them out, and you'll see the difference. How you perceive the market. It's a lot about perception. What's in your head? Well, most about it perception. So that's why I don't freak out as much as I used to years ago. So here you have, and this is what defines it. This is 10/4, right? October 4th, and this was last week. So looking at this pattern here, this is shaping up to be possibly a head and shoulder. I'm sorry, a convoluted, a complex dragon bullish. Somebody says, well, whoopee, it's off to the moon, right? That's what people start thinking when markets start to rally. I say, hold on your heads, hold on, because you got to hit the brakes soon, i.e. sell. You got the upper Bollinger up here, which is in the 210-30 range, and then you got this big red line here, and then you got intermediate. You can start seeing the green lines, which are the resistances. I always mark them. I try to put these markers. Takes a lot of time posting this little thumbtacks, right? This #1 thumbtacks, but I'm sure it helps people. So here, and then we can go possibly to about 27.50, and that comes to the same levels that we talked about on the other charts, which was around 21.75. Knocking heads to enter into the upper channel. Major resistance, major resistance. I draw these lines here. To me, these charts are so geometric, they're actually fantastic. And I'm sure a lot of you see it that way. If you're using Quad, just replicate it. I'll sit with anybody and have them set the charts up like that. Let me know, and we can do that after the market. All right? My offer is open. And so here, once you get overbought, same old story, same old story. Here is the difficulty. Okay, so once it gets overbought here, one way or the other, the slow Stowe is going to reset. Question is when? That's where traders get all messed up. Because a good portion of the time on a powerful upward moving market, which could be shaping up here. Okay, just the way we did here. Look how similar it is. It stays overbought for maybe an extra hour, 2 hours, and everyone just gives up, says, no, I can't buy the puts. And guess what happens the next day? Bang, down. Not immediately, but it does that. So that patience and discipline that's needed can be very excruciating. So that's why don't lump in too much. You buy a few puts because things get overbought. You see the big red arrow. You're starting to see some candles, but the market won't give in. It's almost closing bell. You're like, man, I want this market to drop. I got this puts. It won't give in. Because that's what algos do, because maybe too many shorts got in there. They don't want to pay them at the end of the day. So a bunch of traders, what I find, they give in. That's it. I'm taking that minor loss. Market's just too strong. It won't go down. Guess what happens? Market opens, does its thing, and then drops exactly in order to reset. And we realize 200+ % type of gains. And a lot of them are sitting on the sideline saying, oh, should have just held on. Well, that's what happens, all right? So saying all that, this really helps me manage my trades very well across the board, not just on SPX and stuff, across the board. So saying all that, none of the stock charts, just so you know, individual stock charts are as defined as the market. Okay, defined as the market. So coming back to it, the slow stows can take a full couple of hours, or it can take a full day to reset. It can take a full day to reset. And a full trading day, when you want to make money in 5 minutes like I do, let's face facts, we all want to make money right away, it really gets annoying. But that's okay. Control your annoyance. Keep on studying the technicals in between other stuff that you're doing. So now that this is cleaned out and come down at this level here, a logical move, not that anything is logical, but a logical mathematical move is we get overbought. And that brings us to the major downtrend line here, which the market can fail. It's failed the downtrend line a few times now. Okay? So watch this red line that I've had on my chart for weeks now. I purposely I put a small red arrow here because that's a downtrend line. Once it breaks out the downtrend line, you're looking at the next level of major resistance, which is this upper Bollinger. Now, in markets which are very strong, Bollingers don't stay static. Bollingers are simply a mathematical representation of trading ranges. So if there's a big push up, then Bollingers turn. Bollingers can snap higher. Just the way Bollingers can snap down like it did here and get pushed down because of the velocity of trading and the pressure, right? With this candle down, the second candle down, right before the market basically turned. And that was the second trend line. It hit exactly my second trend line and the support level generated by the pivot points. I mean, sorry, generated by the support levels, you know, right there. So both hit, and I said, you know what, this looks like an interesting point. And that also coincided with Mr. Stowe, who took his sweet time starting to curl up. When all these match up, it's a buy, technical buy. Technical buy. So saying all this, this does generate a significant amount of money. If you know, like I said, it's not that hard to read. I put all the things in place, but you have to replicate it on your screens. And over time, you start to somehow sense the turn. And once you sense the turn, you are 2 steps ahead, not 1 step ahead of what the market's going to do. I'm telling you that right now. And that is where the big money's made. But if everybody's 2 steps ahead of the market, then the market is, then you're not 2 steps ahead. Do you understand the dichotomy of that? If everybody knows and are 2 steps ahead, then you're not 2 steps ahead. Then you're in line with the market. You understand what I'm saying, everyone?
Yes.
Exactly. So you always, you know, just being a contrarian doesn't mean you're going to make money. What if everybody's a contrarian? So that's what I'm saying. A washed pot doesn't boil. So if everybody's watching the same thing, it's not going to happen. Luckily, very few out there watch this type of charts. They watch their own things, and I'm okay with that. I would like to be one step ahead or 2 steps ahead, take a little bit of a position, and then as the gang rush and what I call the lemming chasers come in, I'd rather give it to them and say, okay, see you later. I was already in here. So that's one way of doing things, you know. Are we right all the time? No, we're free right a lot of the times. So that's your quad representation of what's going on. This is looking good going into tomorrow, Columbus Day. And I think we get this type of move where we get overbought again. So don't get all foolishly excited once this Mr. Slow Stowe, that we have deep respect for, because he's been proven right over and over again, gets up towards that level. Once he gets up towards that level, I normally put out a small short, and guess what happens after that? For the next hour, I'm upside down. Not too much. If I buy, let's say, short at 6, SPX put at 6, it's maybe down to 4. Because the algos always test you. So what I do, like I mentioned before, I'll buy a little bit more. Not crazy, buy maybe another 4 more or 2 more. Because I know the reset's coming. But here's the thing here. Some days when there's a heavy volatility, you can do it intraday. Other days, buy a little bit of time. You know, if it's Monday, maybe buy the Wednesday, or if it's Wednesday, buy the Friday. I don't find any logical way of justifying to myself on a Monday buying Friday, especially on active trading on SPX. Remember, SPX is the one that trades Monday, Wednesday, and Friday, right? No in just my opinion, I don't see any justification to buy the Friday ones, because we're going to get a reset on Wednesday, most probably on Wednesday. And if you don't get it on Wednesday, you get it on Thursday. So what's the point of paying the high premium for Friday when I could buy them back cheaper? Do you understand what I'm saying?
Yes.
Even though we'll be probably, could be up on Friday. But in the meantime, so it's how people do things. So given that, why do you think they introduced the Monday SPX call, options? Because the market demanded it. Remember, the CBOE doesn't just introduce products because they're geniuses out there. They're a money-making machine. They want to trade volatility. So that's why they introduced the Monday one. Because the Monday one serves the purpose for active traders, hedge fund guys, not necessarily retail. A lot of retail traders just trade the SPYs. So anyway, still, they said, okay, Monday, Wednesday, Friday, 3 pivotal days in the market. Let's trade the crap out of whatever events are coming out of there. That's the reason why they're doing it. So why they introduced it. So why shouldn't we, as smart, clueless, say, trading traders, and I mean that, we're a lot smarter than out there, okay, take advantage of it? That's why I'm saying the hedge fund guys who are playing event movements are not sitting on Monday saying, I'm going to buy puts or whatever for Wednesday. I mean, for Friday, the active ones. They're doing it for the following 24 to 48 hours. So it's up to you what you do. And we'll go from there. Daily chart on the daily chart actually is still that triangle, but I'd rather show it on this. So here we are with, let me start off with the E-minis. From the depths of the market back at the beginning of the year, which we all forgot, we had a big, massive dragon bullish formation after horrible January. Not for us, but a very difficult January for the overall investor out there. So here we are. But I would rather look to see where we are from Brexit, because that's what matters. So here we are from Brexit, right? Talked about this before, talk about it now. I find this chart that I have, and I've put it out there to share with everyone and for all of you to use and benefit, very helpful. It's very direct. We're moving in a sideways trading band. Yes, we have a crossover. And Van Ter brought a good point. Said, why are we buying even calls when there's this crossover? Well, I'm saying that that crossover is intact right now, but I'm talking short-term movements. We are using the 1-hour charts, the 15-minute charts. That's the reason why we're going between calls and puts. But just in general, we do have a negative crossover on the daily right there. That's the 34. That's the 50. Okay. However, look at the shape of what the candles. The candles are in a very tight formation, and like I've said, both sides. I'm explaining both sides of the picture. I am not biased on one side or another. Okay, I'm in fact a little bit bearishly inclined going into this part of October before the last week, where I think the market just zooms ahead, because contrary to public opinion, if the public does have an opinion, right? All right, just kidding. Is about the market I'm talking about. October is actually a positive month. I don't know if you guys knew that. Okay, you can look that up. October is actually a positive month after the intense volatility and drop downs and stuff in the middle of the month. Just remember that. And that included October 1987, which was a long time ago. And I didn't even know what the Wall Street Journal was. No, I'm just kidding. So seriously, I didn't. So the point is that, well, of course I knew what it was, except I never looked at it. So saying all that, you got this movement here within this band. Very clear. So if you're going to trade the market, you trade it between this band. extreme upper end of the band, and I say extreme, is 2172 on the E-minis, and the lower end of the band is this, or you can move it down a little bit more and say, hey, I want this to intersect with the lower Bollinger, which is this yellow line. I'm sorry, the blue line, if you want to be, very perfect. Or I would personally, I would just move it here because it's pretty clear to me that this is the level that the market wants to bounce off. So if it's going to bounce off here, you can play the market for a good 30 points, 2160, right? 2168 and 2130, back and forth, back and forth. Not easy, but you can do it. Once it breaks, then this line comes into play. And in between, these two magenta lines are the Darvas box, very wide range. I haven't seen the Darvas this wide in a while. This was just a powerful surge, so the Darvas kept on getting pulled up. But here, it's like sitting there saying, okay, you can either give me 2190 on the E-minis or you can give me 2100. I don't give a flying you know what. That's what Mr. Darvas is telling us. In the meantime, play along. So looking at this alone, looking at the candle structure, it's nothing but sideways volatility. It's nothing but sideways volatility. Here is when you know that there is a intermediate multi-week, I would say multi-week because algos are so fast these days, I'm not going to even bother saying multi-month. All right, a multi-week, and I'm not going to say multi-month because right after the elections, after the initial drop, whoever comes to power, there's going to be a huge surge in the market. That's a given. All right, going into December. So get ready for that one. So point is that the point is that when this is when it gets troubling for a multi-week correction in the stock market. The 34 and the 50, which is moving kind of sideways. 50 is still moving sideways. Okay, the 34 is the one which is creeping down. It did that same thing here too. All right, it did it multiple times, by the way. So the point is that if this suddenly sharply, the 34-day moving average moves down like this, it's inevitably, mathematically speaking, going to pull the 50-day moving average down and curl. It never curls down like that fast. If it ever curled down like that fast, can somebody tell me how fast, how much the market has to drop? Just take a wild guess on a 1-day or 2-day period for moving averages to dramatically just, curl down.
1,000 points?
Yes, absolutely. The funny thing was we dropped 1,000 points here, Jules, and the moving average is barely budged. You see what I'm saying? So
Yes.
it's amazing. Like this is what machine learning is all about. And believe me, I'm like standing shoulder to shoulder, neck to neck with all of you, but I'm like learning it faster. I read a lot of this stuff on the side. It's just that machines are so fast and so quick to do the resets and all that stuff that those type of things which would normally take a week, 2 weeks, sometimes 3 weeks, and I've gone through that back since the 1996, 97 period when I first entered Wall Street. It's like, look at these things. Well, down the road I did. Now it just goes boom, boom. So so you hear these older guys come in and say, okay, looks like this is a real break. Before they can even finish the second sentence, you are seeing massive movements higher. A lot of it has to do with the fact that central banks are very accommodative and there's a lot of money on the side. So unless there's a real massive external shock in the market, like a Deutsche Bank completely blowing up, okay, credit shocks are what really puts market down. So yes, it would normally be 1,000 points, 1,500 points, and you start to see this drop fast. You get 1,000-point drop in the market. I repeat again, buy the crap out of the market for the next 6 to 7 hours the following day because you're going to have a reflex bounce. Shorts are going to cover. So this is the same thing here. We got a drop here, nothing happened. And this is something, but if you start to see this curling down, you don't need me. You'll always need me for some stuff, but you won't need me to figure out when this is starting to curl down that a trend has been established where it'll keep on hitting the downward sloping 50 and the 34, which is not the case right now. There's a minor downward sloping on the 34, mind you. And remember, the 50 carries a lot more weight than the 34 moving average. Just remember that. And the yellow line, this one, and this is real technical stuff, okay? Very simple to understand. The yellow line, which is a 5-day SMA, or the trader's friend, if you want to look at it that way, okay, is basically just moving sideways. Everyone agree? This line, see that?
Yes.
Exactly. And the 5 SMA is what determines what traders are doing. Just so you know that. The other stuff, you know, are not necessarily what fast traders are tracking, the 5-day or the 8-day or the 9-day. I like tracking the 5-day because I think it, you know, it shows 5 days of trading. I like it. So bottom line is that unless we start to see this sloping down, we are not in an intermediate bear market, period. It's going to be wild moves, and that has been defined by this chart. It's as clear as day to me. But please track this on your screens too. Use that. Now, looking at the internals, yes, sloping down. Okay, so we could come down. We could come down as low as 2130 or so. If this gets deep oversold, the daily gets deep oversold down here, which could very well happen by the middle of October, you buy the crap out of the market for the next, you know what, 24 hours, 48 hours, because there will be an inevitable bounce, and then the volatility candles will start picking up after the initial bounce. You can make a decent sum of money on this and then use part of those proceeds to do intraday shorts and longs and stuff like that, like we do. Okay, so that's the daily. Now, let's look at the internals. Minus 124 is not extreme oversold on the daily, but it is getting down there. Just so you know that. Where do we consider massive puts hands down buying? Is when we are down to minus 150 or minus 200. You can track that on your screens too. The McClellan oscillator never lies. It gets confused, it gets drunk, but it never lies. All right? So the McClellan oscillator down at these levels, whether it be Brexit, you see McClellan oscillator minus 169, you don't need me. Just buy whatever you can within reason, of course. Always have cash on the side, and you can basically play the indices. Playing the indices are the cleanest ways you can trade volatility. I repeat again, playing the indices, the SPX, the RUT, or the QQQ, whatever you do, is the cleanest way that you can handle volatility moves in the market. Individual stocks will do whatever they need to do based on news flows, based on this, that, and I've explained about that before. Now, let's take the same view of this chart on the SPX, on the daily. Same story, right? You can always draw the downtrend line, but this is the same story. It's moving between SPX 2142, let's round up the decimals, and the upper end of the Bollinger, Darvas box, remember this is the Darvas box, of 2180. So you got 40 points that the market's trading in. 40, right? 2140, 2180. That's roughly 240 point moves, which I think pays the bills nicely if you can catch any one of the moves. And you don't need to catch one of the moves. Just do it intraday. That's it. Now, let's look to see what this is doing as in the shape of the lines, because that's telling me a lot. 34 sloping down a little bit. 50 doesn't seem to be giving a hoot about what's going on. Kind of sitting there saying, okay, come on, test, retest, you know, dance with me. That's what he's doing. If this is starting to curl down the 50, then the 34 is going to go whoops, and that's when you know you can short every rally for a short while. We don't know that yet, because to me, as somebody who looks at patterns all day long, I think I dream in patterns too, and I'm just kidding. So the point is that I'm seeing this is your trading range, 2167. You want to be more conservative, you want to go down and say, okay, 2165 and 2145. That's what we're doing. Now, if somebody thinks it's going to be a huge break up and a huge breakdown, yes, it can happen. I explained the reasons why, but I really don't want to even think that far about huge breaks up or huge breakdowns. I just want to see whether or not it can get up here, whether it can get up here, or whether it can get down here. And I'm just trying to keep it simple, honestly. And it's okay. It's making money. So that's it. Those are your inflection points. 50. This coincides with the Bollinger, upper Darvas. This, by the way, the lower Darvas box does not coincide with the lower Bollinger. This one does. So that tells me something, that the market has limited upside for now. Now listen to this carefully. Because the confluence of the Bollinger and the upper Darvas is exactly the same, this carries more weight from a technical analysis standpoint in my book than this. This is telling us that if this was curled up like this, okay, and they met like a meeting here, then I could kind of convincingly say, on a technical basis, hey, that's your downside. I don't think we're going to go down that much, but it's not. It's telling us very clearly that if we break here, we're going to fall here real fast. Big frigging deal. That's 16 S&P points. See, this is the difference between clueless day trading and other services and stuff that explain all the things and do what they need to do. We're not preaching huge euphoria. We're not preaching doom and gloom, Armageddon. We have a bullish bias with a cautious stance. That's what we're doing. And I want everyone to hear that, not just here, because many people will listen to this video cast today. We are bullish within reason. We are cautious within reason. Questions are, let's figure out the reasons and try to make head or tail out of it. That's why I worked so hard in putting all those charts out there. And all of you in here, and many of you out there, are focusing more and understanding it because it's not that difficult. And then you replicate it on your screens and you actually make some money of that stuff. That's when you get more interested. Don't forget the rule number one in trading and investing. Interest comes out of making money. Remember, interest doesn't come out of sitting on a dry technical analysis session and listening to all the technicals mumbo jumbo. Interest comes about because you apply those tactical moves on your screens and you actually make money. That's where interest comes in. Why do you think I'm so interested in trading? Because I think it's the best thing in the world. Yes, I actually do think it's the best thing in the world, but also because I have done well in it over the years. And I find it to be a fascinating field. So saying all that, we have, so that's it. Now, enough of this one. This is clear. I want to have this one down to that. And I was saying, so the drop from 2141 into 2125 is 16 S&P points. Multiply 16 with, like, let's say 7. You're talking about 100 Dow points. So this is a minus 100 Dow points. If we break, we can handle that. We can handle that easy. It breaks this, that's a different story. So that's it. Now,
Hey Frank,
go ahead.
Do you think that last candle on the daily almost looks like a hammer?
Yeah, it does. It certainly does. But remember, the last candle of the daily is not like a defined hammer. A defined hammer is something like this. There. Get it? Where it just rips up and the body, it closes right at the top of the thing. That's a defined hammer, which almost, I hate the word, almost assures, how about that? Guarantee? Never use that word in the business. So assures you that you're going to see a multi-day rally. This is more like this. See this? These hammers are just there. This is Corey's right. This is actually much better looking because the tail is longer than this one or this one. This one even didn't tell us crap, yet we still made money. After the market fell the next day, look at the hammer reversal. And this one was just like a big red blob, but it was an inside day. Everyone understand inside days, right? Where the body of the candle is within the previous day's this was naturally, I can't compare this to an inside day. It was an inside day compared to this, but this is an outside day where the body of the candle is outside the bounds. Opens lower, big move up, opens higher. Next day comes down, people freak out, but continues the continuation candle. This is an outside day or a bearish engulfing. Yes, so coming back to Corey's statement, this is more of a hammer than what we have seen. It did close above the mid-Bollinger. You can see that. Everyone see that? The mid-Bollinger closed above that. It tried to close over the 34, but thanks to Mr. Sterling Pound, not Mr. Slow Stows, Mr. Sterling Pound, and whoever's doing those flash crash type of fat finger trades or whatever they're doing in the middle of the night on Thursday night, caused some pretty big fat institutional margin sells by a good number of hedge funds. Guaranteed. And I know it. It happened. Because there were waves of selling coming, and that had to come from the currency markets out there. And a couple of, and then other reasons too, Honeywell, warning and this and that. So saying all that, this again is this is your zone. It's got to break out over the 50, which would cause a flurry of buying. And otherwise, it's just going to let's put it this way, at least for this is going to be a volatile week. I know it. So the point is, will the volatility be similar to this? Yes, could be. Will it be wider? That's a good possibility too, just so you guys are ready for it. So we're going to keep things small. I know I'm going to be very active intraday. I don't know how much I'm going to carry overnight because you can't tell these days anymore. That's the problem. Fantastic setups, and then you wake up the next morning, futures are down 20, and then you're scrambling to basically buy the lows and come out even or higher by the middle of the day or the end of the day, and it just gets a little bit too much. So I'm being very straightforward. It's very tough to tell overnight volatility these days because there's so many factors running the markets, and I would say that's it. All right, so let's move on to the next picture, which I think helps us because this is a daily view. Let's take a look at the 1 hour. Now, this was the line, that's the downtrend line, so forget that. The face of volatility, waves of waves, right? So this wave, like I said before, like Mr. Stowe's are showing on this chart that I just showed, this one, right? Like it's showing here, this carries a lot of weight. Now it can move sideways like it did here a bit and frustrate everyone. But if it's starting to slope up, you can rest assured there's a 90% probability, in my opinion, based on past movements that you all have seen, that the market will rally. Doesn't have to do it in the first 2 hours of Monday. Just remember that. It's just the way it is. So saying all that, this pattern, and Corey, your question was much easier for me to explain doing that this pattern is very similar to this, and I think this is what's going to happen. We're going to get up to 165 or so, 2165, flounder around, create maybe a small cup. So if you create a small cup from 2165, that means you're going to come down to 2158, and then what I consider that the max move is going to be around the 2175 level before we hit some major resistance. So on the 1 hour chart, the 1 hour could very well be overbought, which brings me to a very important point. A lot of these resets, in fact, a good number of them, ladies and gentlemen, happen pre-market or after market. So if we're waiting around thinking, and there's nothing we can do, just so you know that, unless you're a futures trader, is you're held hostage to some of these resets happening pre-market, which has happened quite a bit. The volatility pre-market is very heavy these days. So a lot of these things that I'm explaining are not necessarily reserved timing, is not market hours. They're happening pre-market. So once that happens pre-market, you got to adjust. If we open up 4, 5, 6, 7 S&P points, we'll be overbought right at the open. Back to the game again. They're gonna reset it. Resets never fail. They just don't always happen exactly when we want, but they happen pretty fast. So once you get overbought again, especially on Mr. Slow Stow, which is more steady, cuts out a lot of the short-term noise, then you don't want to mess around. You want to go at that point, have a couple of puts and just leave it in there and let the market on its sweet time reset. However, if it's a very powerful market for whatever reason, we could get some strong earnings with the earnings season starting up. Markets can remain overbought and kill a good number of the shorts, which brings me to my next point, and a real important one, because I've been caught on the short side and it has been pretty. Okay? Not with anything crazy, but it doesn't feel good when the puts don't work at all for a day or 2 days, because by that time I'm out. Take the loss and move on. So bottom line is we have a good number of institutional shorts still in the market. That is the sole reason why the markets do not go on a intermediate correction down and stay down. The shorts are preventing the market. And listen to this, and I've said this before. The hardcore dogmatic shorts are preventing the market from correcting, because every time the market comes down a little bit and then starts to stabilize and the machines come in pushing the other side, they cover. They cover a bit, but then they short again. The more they short the market, the more Mr. Market will push higher. Just so you understand that. Everybody, majority still crowded on a bearish short-term or intermediate term or long-term, whatever the case may be, short position. Believe me when I tell you. You feel that all around you. None of us, even people like us who are tactically bullish with a cautious stance, are not really bullish. We're not showing that with our money. Otherwise, I'd be saying, hey guys, don't take moderate position. Just go nuts and, hell bent on buying the crap out of the SPX calls. You hear me say that? No. I say it's a good probability betting. I sound very kind of, circumspect and watch my words, what I say. So as long as people are, let's say bulls are acting, talking bullish, they're talking the talk but not walking the walk, the overall sentiment is still cautiousness and bearishness. Nobody is saying throw money into the wind and buy the crap out of the market. Nobody. That is the reason why the general market in general does not have a long-term or intermediate time corrective phase. And even Brexit, which was the most dangerous thing that happened to us in 10 years, at least I'm talking market-wise, right? Market reaction-wise, did not collapse the markets because the shorts covered. And you have to understand, that's like, that's basically a little bit out of the box type of thinking. Saying all that, what can I say? Okay, let me open up for a question or two.
Hey, Frank.
Go ahead.
How do SPX stochastics reset overnight since it's based on cash?
I don't know. I really don't know. The SPX, the E-minis, I mean, are the ones which are the ones that not SPX, but the E-minis are the ones which are resetting all the time. A lot of this, this E-mini, for example, let me just do this. Let me do 1 hour. This is a real-time chart, Thinkorswim, right? So it's like trading 24 hours. So let's go in really close. 5 minutes. Okay, so here's Friday, right? Here's Friday. Here is this is Friday, and look what's going on. This was Thursday's close. This was Thursday's close, 4 o'clock, right? And you tell me if these are constantly, look at this. All these resets are happening. This is all overnight. From 4 o'clock in the afternoon, Thursday. Look at all this. Till markets open at 9 o'clock here. This was the big spike where I managed to sell a bunch, not all of it. I wish I'd sold all of it. The SPX calls, the spike was at 9:30 right there. Then the big reversal. Okay, so all this is happening overnight, Corey. Like I said, I'm not a futures expert. I know how to read the charts very well. A big flurry of selling right here, right at the open. That came from Europe directly. And then triggered stops and forget about it. And then you had the last level of selling, which was at 355 and then at 4 o'clock. And this is yeah.
I understand that, but I thought you said the SPX resets overnight. That's what I don't understand.
But here's the simple answer. What's the primary asset or the common denominator between E-minis, the SPYs? It's the SPX, correct?
Yes.
Exactly. That's your answer.
Okay.
So even though they're not trading, they're resetting. So the point is, the SPX is the asset, and the E-minis are the first derivative of does everyone understand this? The common base is the index, right? So what are the E-minis? They're trading baskets of the SPX, right? E-minis are not just some like little paper that's traded. E-minis are nothing but they're trading the first derivative or the options, whatever the case may be, on the SPX. So that's why I said the SPX resets are happening overnight. Is that clear in your head? I mean, to me, it's like
Yeah. I clearly get it now. Yep.
you get it, yeah. So you're right in the more simplistic sense in saying, hey, the SPX don't trade overnight. So how are they resetting? Well, they're resetting because their first derivative, which is the E-minis, which are nothing but basket, which are the underlying assets in the basket, is S&P 500 stock, are the ones that are trading overnight. So these resets do they matter. Now, looking at this pattern here from Thursday night, so you went like this. From just a pattern symmetry standpoint, we have a double bottom here, and let me draw this right. Hold on. To me, it looks pretty good, but nowadays, pretty good doesn't count because they'll switch it around based on what happens overnight. Okay. If I just looked at this, Corey, and everyone else, this is pretty good. This is where you're going to find major resistance. Then it's going to do this. See how this is your left side. It's like mirror, mirror on the wall, right? Who's the fairest of them all? What was that, Cinderella? I forget. I remember from, okay, left, right. So there you go. Exact pattern. Now, this would be the case, and a lot of the times it is, when markets open on Friday. I'm sorry, on Monday. Now, keep in mind, general volatility in the market is normally subdued because of no bond trading. Fixed income markets are closed. Banks are closed, correct? So normally are subdued. It's Columbus Day. The last I checked, we don't crash on Columbus Day. So there are some other seasonal factors involved. However, as we get into the latter part of the week, that's when volatility is going to spike more. I'll be very vigilant, do as much as I can, and I will move from there. Any other questions, please?
Frank, would you mind taking a look at Clovis?
Yeah, sure. I was hoping to look at some stocks. So I don't have access on this particular computer to my quad charts. Clovis is drawn very nicely on my quad charts. So I'll attempt to see what here I have structured on Clovis, which is, I'm long Clovis with you. So we're in the same boat. So if we look at Clovis's chart, I actually have it here, I believe.
It just looks like it's way oversold to me.
It depends on the time frame you're looking at, right? On a short-term basis, way oversold.
Yeah.
On a longer-term basis, where is that? Actually, I'll do it entirely on this. So let's take a look. This is Clovis. So when you look at a longer-term basis, the stock is deep oversold. I mean, it's like, just what I had drawn the first time with the Fibonacci retracements. Remember that? So
Yes.
let's do the Fibonacci retracements right here. So you got a Fib retracements, real simple. Do it like this. The 0 is down here, right, at 1157. And let's look at the bigger picture. Bigger picture is all these type of stocks. Now, biotechs carry a much higher element of risk because of all the different things that we are familiar with, which is FDA approvals, Clinton going bonkers on the biotech industry, idiotic stuff, all that stuff. So basically, all kinds of different outside effects on biotech stocks. But in general, stocks on a large-scale basis, on a multi-year basis or a multi-month basis will retrace. I repeat, 50% retracement. That is almost standard procedure. 50% of the, and that's at a standard situation. Biotechs, obviously, let's give it a little bit of extra risk. So here's 60 and here's 50. My gut tells me the stock is good to go to at least this $49 range or 50, which is the 38.2 Fibonacci retracement. Now that's a Fib mathematical retracement. Let's take a look at the this will start showing the light of what's going on. Let's remove, I don't have any drawings on this. So what Clovis did is on the daily, the moving averages are Just fantastic. There's nothing they're doing wrong. See, 34.50. It fell hard, tested the 50 moving average at 25, right? And then created this powerful, in my opinion, doji. This doji power, not just the shape, this green pattern. You see this green here? Okay, that's not a hammer reversal, that's a doji. Means indecision favoring the upside. Okay, so saying all that, what validates my point more? Look at the short covering. The size of this green candle. Adam Feuerstein, I can never see his last name. He's a big name in the biotech side, right? So he writes this newsletter. He's made some great calls. Big frigging deal. He's the one who said that it doesn't look good for Clovis's whatever drug to get approved by the FDA. It wasn't an actual news, but that's what happens in the market. So whoever covered with this size volume, the volume was 20 million shares or thereabouts. The last time we saw a volume on this was here, correct? Not even close, 12. The last time you can think of Clovis even coming close to this type of volume was back on the 23rd of August. Guess what the stock was at that time? Just coming off the lows, 17, right? What happened after that? There was a big sell but the stock continued its upward trajectory from this level the last time we saw volume like this. So if somebody just said, hey, give me price and volume, you know, that's what I believe in. I say, excellent, let's look at price and volume. Massive volume reversal, green doji, tested the 50, going higher. That's what I would say. The old you know, in the old days when we didn't have all the fancy other stuff that I look at now and the algos and everything. Now, we do have the Darvas, just so you know, just went like this. Look at this. See? Just down here. So the upper Darvas at 32.49 needs to be broken out. Needs to be broken, has to break out above that in order for the stock to complete, you know, continue and resume its daily upward movement. Let's take a look at the internals on the short term, which is giving us a more microscopic view of what is going on. We got massive short covering. Okay, fantastic. We bought off these reversals. Some selling, nothing big. If these red candles were significantly higher, okay, than the green short covering, I wouldn't be. Short term, I wouldn't be basically even mentioning it as a buy. But that wasn't the case. And I was watching this. Internals, kind of mixed. This was deep oversold. Buy the crap out of it. And then there was a little bit of selling at the latter part of the day. I'll accept that. The first round, I took some profits and I rolled them out to the 35s because I do believe that on a sharp move up, as the shorts cover more, when they realize the stock is not going any lower, you can very easily, in my opinion, get to 37 or the upper Darvas, which would just make you the happiest person in the world. Right, Jules? And me.
Exactly. Yeah, I bought some on Friday.
Exactly. And so the smart way of doing things, I don't know what smart is these days, to be honest with you, is to basically buy. And if you start to see big red or green candles develop, and this is another very important topic I want everyone to understand. Momentum trading, whether it be in biotechs or whether it be in any stock, but in biotech especially, has to be respected. In my opinion, on candles of this magnitude, everyone can see this? Where you get these big fat candles, I will be a buyer, not a seller. Because I know that type of candle is coming from big money rushing in, shorts getting squeezed, okay? And that there will be a follow through for the second and third candle. So saying all that, people will say, oh yeah, I bought a little here, I sold here because it's too overbought. I say hogwash. When you see heavy volume reversals and big fat green candles, momentum traders, and I've shown this repeatedly in many, many cases, you got to buy in. Yes, there'll be a little sell-off maybe the next day or so. You buy that, and then you sell the second or third candle. That's when the rest of the lemmings come in. Get it? and you want to feed the lemmings by giving your shares to them or your options that are up 50, 60, 100, 150%, saying, see you later, I'll come back and buy you guys when the algos hit you. And that's exactly what happens. This happens to all stocks. Okay, so when you see the first candle, you start rushing in there. You do jump on a running train before it really starts to speed up. Saying all that, there's always risk in the market. We know that. We play risk. But these candle movements have to be respected. You see big fat candles in the market move up. You don't sit there and say, oh, I'm going to wait for a dip. Yeah, there might be a little dip, but it won't give you a chance. So that's the case. Let's any other stocks anyone wants me to look at? Nia? Yeah, go ahead.
Oh, this is Seashell.
Yes, I know.
Hi, can you kindly bring up the CMG swing chart, please?
Yes. CMG has bottom unless they get another salmonella, or I'm sorry, whatever attack. One second. Richie just responding back to our friend Richie. He's got some business projects going on. Richie, active member and big ones. He's doing really well. So he's been away. He says hi to everyone. Okay, he'll be back shortly. All right. So here, let's look at it a little bit long term here on Mr. Burrito. I can't even tell you, and this is just my opinion, right? How powerful this chart is in the sense that I don't expect the good old Chipotle to go back to 700, but what the heck do I know? Like really, I mean it. Okay, but this large macro falling wedge is one of the most powerful patterns on a big cap stock. Remember, it's still a big cap stock, right? Because the last I checked, they weren't burning down Chipotle restaurants. This big cap stock. So let me show you a couple of simple things here. All right, this is your monthly chart here. Because it's honestly, it's in my opinion, this is a great buy some frigging leaps on CMG going down to maybe next summer, or buy some long data calls going into February. Because regardless of what happens in the election, what's Chipotle have to do with it? Their biggest nightmare is another food poisoning or E. coli outbreak, and who knows? Maybe the Russians are going to inject some E. coli into the Burritoville. Seriously. That's the biggest risk. They don't have election risk. They don't have that much of a huge, foreign currency. They don't have any foreign currency risk. So, a couple of things here. First, let's look at the chart. Price and volume, right? So look at volume, heavy, last month. That was the month of September. Okay, see? So, massive, all buying. 23.28 million shares were bought. That's not you and me. Those are funds who are buying the stock, regardless of all the garbage they spew out there to throw all of us off. Remember, a lot of these guys lie, right? When they're buying stuff. Oh, we don't like it and stuff. In the meantime, they're buying the crap out of it. It's a standard procedure. It's a game of poker. So, 23 million shares bought in the month of September. Love it. Month of October just started. How many shares? Look on the right. 3.9. Let's call it 4 million. So far, 4 million shares have been bought of this stock. There's buying all over. Now, this is longer term. Now, let's look at this. This is a macro falling wedge. What do macro falling wedges do? This is what one of the first lessons when I start the ACS sessions, I always teach people. You get big falling thing. This is where you get the dimwits trying to short the stock for a couple of points. They keep on getting burned, and then the macro fall. Then this, and on top of that, this is a macro falling wedge and Darvas. Look at the Darvas. Okay, so what's the upper end of the Darvas box? 446. What's the lower end of the Darvas box? 386. Look how tightly it's trending. Look at this bottleneck. Look at this bottleneck. Right? Look at this bottleneck. This bottleneck matches with a lot of stuff. Now, people think, oh, 446 to 3 or 400, 446 to 400. Oh, that's the end of the world if it gets close to 400. Garbage. 390 to 400 is your long-term support for Chipotle. Period. and the stock breaks out of the bottleneck, and let me show you a couple of other things I noticed the other day. This is what is this line here? Instead of me repeating, I want to ask a couple of quick questions because these will help all of you do your own stuff too. What is this line? Quick, come on. What is the white line here? Come on, guys.
Multi-year breakout.
Thank you, Corey. Exactly. All right? Exactly. It's a multi-year breakout. That's when the stock went berserk on earnings. I think we were there. We were there. And that was October of 2013. I didn't have my service there. My service started on April 15, 2014. Man, we're pretty new. So I played this. I remember. In StockTwits, my charts in there somewhere, but I have a copy of all my charts. People were like, "Oh my God, it's you get amazing." Like, I started to get a chorus of people saying, "Hey, you got to start a service and stuff." Believe me, I didn't want to start a service because I'm too lazy. I like trading my book. So anyway, and I love the fact that I did because that's how I got a chance to meet so many great people, and I mean that. So saying all that, big move. So that multi-year breakout is, lo and behold, where? Right there at the upper end of the Darvas. If this thing crosses over around the 445 to 447 level, you're going to see a move of this magnitude up to $500. Let's make it more precise. You're going to see a move of quick 50-day, it's a 50 SMA on the monthly, 509. I have a feeling their earnings are going to make that move happen, ladies and gentlemen. So whatever we do, let's have a little bit in there right before earnings. Because this is my opinion, obviously. I don't think the stock's going down anymore. Now, why do I say that? There has to be validity instead of me just saying that, all right? You got on the monthly, now thinking ahead a little bit. So monthly, you got 509, the retest of the 50 moving average. Like Corey correctly pointed out, this is a multi-year breakout line. It is also the confluence of the upper Darvas. 572 is the 34 moving average. Here's the funny part. This stock fell from $750 to $387, right? Almost a 400-point drop. Can anyone tell me why the moving averages on a monthly basis never crashed and crossed down? See what I'm talking about?
It happened so quick.
Not the full reason. It's because it happened and then a lot of buying came in. Regardless of the garbage that you hear out there from one second. Here's this line here. One second. I'm trying to get this. I'll explain to you. And these are just stuff that I have applied in my trading for years, and they work. I guess. What is this line? That's a UFO line, okay? So anyway, so it happened, right? So look, listen carefully. So look at the acceleration when the funds just said, "That's it, Chipotle is over." A lot of stops triggers. At this point, Chipotle was fatly overvalued. No question about it. Then all of a sudden, all this crap happened. They lost a lot of money. So you got this months of 1, 2, 3, 4. These 4 months where the liquidation happened from a lot of big funds and stuff. Everyone follow me? Then the buying started. That was in the month, oh God, hold on one second. So the buying started on the month of February of this year. Then it seemed like they were getting over the hump. The selling started because the second E. coli happened, right? That was April. Since April, the months of May, June, July, August, September has been a net positive in the form of acquisition of shares than disposal of shares. If you add up the volumes of this, the green candles, they are far higher than these 2 red ones that you're looking at. Whichever the case, it's in buy mode right now for serious investors within Chipotle. Now, Ackman, right? He's the one who took the Chipotle position the day we were just hit the lotto ticket with our calls, right? It's Bill Ackman who took the big position. Was it Bill Ackman, or who's the big investor? Who's the activist investor within Chipotle?
Ackman.
Ackman.
Bill Ackman.
Bill Ackman. Yeah, I was mixing him up with other guys. Sorry. So saying all this, this is a very important line here. Once we on a technical basis see crossover over 450 or 447, you got to buy the stock. It's going to move fast and furious. We all know when Chipotle starts to move, and this is on a monthly basis, it'll move fast and furious. There's no looking back. You got to take that position. You got to sit in there. This is not a Tesla. Yeah. So let me finish. Let me finish my thought. So you got a macro falling wedge. You got all this going on. Now, let me try to define my thesis by looking at, validate my thesis by looking at the internals. This is a beautiful turn, slow but powerful turn of the moving there. This is very positive. The last time this happened was when the stock fell out of bed from $100 down to 36 back in 2009. Okay, during the big fall in the market. So bottom line is, every single time you see a turn like that, and this is certainly positive. I'm not saying it's not going to vacillate around, but this means a monthly breakout on the stock is almost imminent. What happens on a daily basis in Chipotle is somewhat meaningless because the monthly charts are clearly showing that the stock wants to go higher. Now, let's take a look at the daily. Actually, before I go there, let me show you guys something here that I noticed. If you do what did I say about the Fibonacci retracements? That generally speaking, on monster stocks, big cap stocks, real companies, you get a 50% retracement of where the stock is. Lo and behold, 50%, 50%. So if somebody says, well, if it completely everything, crap hits the fan, where can we go? You can on a mathematical basis say 38% retracement, $315. Do I think the stock can go to 315? Who knows? But at least chart wise, that's your worst case. That's basically the next stop. Can it happen? Can they say something terrible that nobody's going there and nobody's eating stuff? Who knows? My gut tells me that it's going to get to 490 first before it gets here, if it gets there. But it's funny how it gave back 50% of its value after the monster run. This was the highest performing decade in a decade, right? The stock, Chipotle, is like one of the top ones. So that's the longer term view. On a shorter term view, my quad charts actually have much better charts. That's what I kept on posting. Look at the 4 hour. Let's take all the lines out. Let's do this. Let's do this. 1 second. Let's draw it here. Just look at the supply and demand points. Supply points are where people sell. Demand points are where people buy. Not people, but machines buy or whatever. Money comes in. Let's make this a big fat line. Turn it blue. What's the upper level? 467. I've showed that on my quad charts too. What is the shorter term level? Bingo, 455. Hold on, duplicate line. Okay, 455. What's the lower end of the band? Lower end of the band on a worst case scenario is 385. And then of course you have a crossover here. So let's look at this line here. Forget about 542 for now. Crossover, positive. This is positive. 3450 crossed over nicely on the 4 hour chart. Remember, that's the closest thing to a daily. All of you know that, okay? So it cuts out a lot of the intermediate short-term noise. Every time that we see a crossover up, the stock ramps up. It ramped up from here. Now, upper end is here. We have the upper Darvas at 434. So short term, somebody's looking, oh, what's going to happen on Monday? We need to break out of 434. We need to break out of 434 in order to get there fast. If somebody says, okay, let's look at the volatility range, well, this is what's going on. Again, it's a complex dragon bullish. What is the upper end of that range? 445. That's your key level, 445. All right? And this is what the stock's doing. Once it gets to 445, can it get down here again? Well, who knows? Let's take a look at the internals. I like it. I'll buy this. Look at that. Getting overbought, but it doesn't get overbought till it gets back into the 90s, right? And that's on a 4-hour chart. Looking at the daily on the internals, while we're at it, still wants to go higher till about 94, 95. That's when you start. That's when the stock's going to be around here. And on the daily, we are creating a, can somebody tell me what this formation is? It's a little bit jagged, but what does it look like from here? From the gap up. Oh, this was the active, Bill Ackman taking the position. It was like a lot of day for me. We had a bunch of calls. Okay, what is this? What is this pattern going on?
Does it look somewhat like a cup?
Yes, exactly. All right, Corey. So cup, handle. You're absolutely correct, sir. It broke out of the handle. And I showed that on the quad charts on Friday. It's a cup and handle. You're absolutely correct. Now, the theory with the cup and handle is, besides from drinking coffee and tea, is that you take the depth of the cup, which is this, right? So that's 440, 395. You're talking about what? 540. You're talking about 46 points, right? So the depth of the cup is plus 46, right? Correct?
Yes.
Exactly.
Yes.
This cup and handle, this thing works, by the way. I've tried it. It works. Generally, you need a catalyst moment. Earnings is one of them. Or Chipotle comes out with news that everybody's not just buying one burrito, but they're buying two. In fact, I think their sales would go nuts if they opened up those pizza stores. I'd love to have some Chipotle pizzas, you know, or burger. They're starting the burger chain. I don't know why they take so long starting their chains. They keep on test marketing in different markets, like 1 or 2 stores, but it never seems to come, you know, to the main sort of wild Eden centers like New York or New Jersey. Okay, so here we go. So what you do is you take the cup, you look what's the upper end of the cup is 441. So you just simply add the depth of the cup to the upper end of the breakout. Add 441 to 46, you come to 487. Good enough for a kiss of 500. So if this cup and handle truly breaks out, it has to take out the upper end of the cup, right? And it'll rush to 487. So that's my second scenario on Chipotle on earnings or any type of blockbuster news announcement out of them. So it's pretty much clear cut and dry. If this cup and handle breaks down below 417 or below 411, it's no longer a handle. That's a breakdown. That means it's coming down here. That's the bearish view. So it's a very technical chart when you look at it that way. But so far, going with what we see, the depth of the cup is 46. This is a clear handle. There's no question about it. We got nice consolidation from 435 down to 425 or 422. We'll take that. That's good. And now we broke out on Friday. So that's
They report on October 25th also.
Oh, they do, right? I'm going to start compiling the earnings stuff. So October 25th. So there you go. So we got some very powerful earnings season. We need to be very, not focused. That's such a cliche. We need to be very strategic about the ones we're going to play. We don't need to go crazy. We can do straddles because there's going to be more volatility this time on earnings. We have to stay away from companies that are involved in international sales too much. We have to stay away from companies which have large currency fluctuations. So I'll do a lot of the legwork on that. So that's the thing. I think Chipotle is a great earnings mover. We'll see what happens. But I just explained to you that the depth of the cup is 46 points. The stock could get to 487. And for Chipotle to move 10% on earnings, 10% is $43, right? Bingo. It's not much. Even 5%. That's why we like these type of stocks for big movers. 5% is $20, right? Yeah. 5% is $20. We'll take a $20 move on some in the money calls or even out of the money calls. Nothing too crazy out of the money. So guys, let's wrap this up. Yeah, go ahead.
Hey, let me say one. I'm out here in California and Chipotle's all over, and the business model is working. I mean, the lines are back.
The lines are back, right? I mean, the ones that I see here, I know the New York ones are booming. I've seen like, not many lines. New York's busy. They have a couple of them. But the one out here where we go get our cat food, and I mean, our for our pets, we spend enough money on the food. At PetSmart, it's like a block down at Chipotle, and it seems like it's busy. So whatever's going on, they're doing it. But like I said, they're internal catalysts, and I think what's going to be really critical for this particular company and many other companies, but more so for this, is their forecast on future sales. Future sales, but more importantly, also what they're doing with their new ventures. They need to introduce a new their pizzas and their burgers and stuff like that in order for that to happen. So saying all that,
would you lastly, sorry about it, would you recommend now to buy a call before their earnings, before the premium price starts getting shot up?
That's a very good point. If you're looking to really have a little bit position in there before it starts to get into the news, absolutely correct. And I know people on our members, some of them do that, right? They get things for earnings premium inflation, as they get close to earnings. I know Scott used to do it a lot. And then some other people do that. Yes, I would. My opinion, And like I said, even if I buy one deep in the money call, let's look at it this way. Let's say we buy a deep in the money call, which costs like a stock. Like, let me see how much is. Sorry. Well, let's talk a little bit about, like, let's say treating it like a stock that you want to hold for 3 months, right? So this looks so much nicer. Look at the weekly. Weekly is like fantastic. It's if this curls, the 34 curls on the weekly, starts to move up, you're going to move up to, again, 542 real fast. This is a pretty damn good looking chart from a technical perspective, not from somebody who's just following prices. Here's your lower end is still 300, but the chart pattern has to be respected. The chart pattern, we call it a Canadian hockey stick pattern sometimes, where it's starting to turn. And then you're looking at 463. Over 463, you're going to see a swing move to 550 pretty fast. But if it gets rejected, I repeat, if it gets rejected at this downward sloping 50-day moving average at 462, then there's a good possibility that the stock comes down and revisits 400 again. So this line has to be broken up. Remember, at 50-day moving average breakouts, you know how many of these old-fashioned managers and technical guys get all excited, right? We know that. They're like, oh, it's above the 50-day moving average, which is good, which is fine. And I'm not debating that. 50-day moving average is considered to be a major thing. But so far, this is where we are. So if you want to play it close to the vest, you got 463, you got 446, and we got all that other stuff going on. So let's take a look at the if I take a look on my other screen on Chipotle calls, let's say I want to buy them. So Chipotle calls, let's look out, okay? So we're looking out to, let's say, let's look at the first ones. Their earnings are 25th, somebody said, right? So the 21st is a monthly options expiration, generally bullish for the markets, blah, 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 the same story over again. So if we buy if the 435s are $6, that's affordable. 430s are, the spread is 780 to 890. That's affordable. So the point is that that's what I would stick to. I'd like to stick to close to the money on these type of things. So October 21st, 430s, just companies comes out with great, the premium inflation, those things that, let's say you manage to get in, let's say even at $9. I'm taking the higher end of the range. You could be up $11, $12, Of course, you're not looking for $11, $12. You're looking for a big move up. So let's say the stock does hit the 440, 450 range, then those calls will be worth some serious money. Now, That's for the earnings play type of thing. Now, if you look out to November, for example, let's say not November. Let's say you're looking out to December. The December 430s or 435s, let's say, are $22, right? So somebody say, oh, wow, there's a massive open interest on the December 450s. They cost you $15. Let me show this to you guys. Yeah, it's directly off the thing. Hold on. So $15. So if it's $15 and you say, okay, maybe I'm going to buy one call or two calls or whatever, somebody wants to buy, and I'm going to treat this like a stock. So I'm going to put in $1,500, $3,000 investment, maybe a little bit more, whatever the case may be. You can do that too. You have enough time left. This is the first time I'm looking at these calls here going out that far. Look at this. 450s, open interest, 2,400. 400, open interest, right there. That's 44 bucks. Okay, on the put side, looks like there's a lot of open interest at there's a lot of open interest at 350, which makes sense to me. It's a nice hedge. You say, hey, I want to play this, if nothing works out, these $2.60 are going to be worth 10 bucks if Chipotle dives to 300. So it's a nice hedge, cheap. Remember, a lot of the times you're looking at open interest and volume, you got to multiply that with the actual option premium, right? To understand like how much money is going in there. Just because it's 4,000, it's $3.50. Here you got 2,000 at 44. See the difference? Look at this here. These are also, they're 400s, which seems like a logical round figure support level. They're at 12 bucks. And the same thing on this side, they're 40 bucks. Does everyone understand what I'm getting at? It'll cost you $4,000 to buy one call versus $1,100 to buy one put. So from a dollar standpoint, there is a big, massive bet on a 3-to-1, on a 4-to-1 basis on the long side. You got it?
Yeah, great thoughts.
Exactly. So that's I want people to think like a little bit outside the box, because a lot of people, and I don't blame them, I used to do that too. So we just look at open interest and we look at the volume like, oh, there's so much volume. But hey, who cares if there's a 1 million volume on something that's worth 15 cents? More weight is carried on, let's say, 10,000 contracts on something worth $4. You have to look at the dollar value, the dollar weighted value of where the bets are being placed. Whoever's placing these bets are not necessarily you and me yet. There's another massive bet at $450. So when you calculate the dollar value of the short side bets going out to December, for God's sakes, right? Or January. What are these? These are what was that? December. Thank you for reminding me. Because half my screen is on the top, so that's why. So these are the Decembers. So when you look at the dollar value, it doesn't seem like anyone's really betting that hard. Yeah, they have a hedge. They have a hedge at $2.60 while they're willing to pay 44 bucks for the calls. End of story. So always when you're measuring a thing, also always look at the dollar value weighted of hedges and stuff out there.
Or the other thing that you could do is that one that you said at 350.
Yes.
Just sell the puts.
Yes.
Because most likely it's not going to hit that. You might as well act like the house and get premium.
That's right. And just so you know, good point that you brought up, there are many different option strategies one can play. They don't have to be binary longs and shorts, right? A lot of times I do binary longs and shorts because honestly, I don't want to sit there and devise a complicated option spread strategy. I want people to do that on their own. I have never been a complete guru on options and stuff. I've done well with them. So if somebody's looking for like a full-scale option strategy, you sell, you do a straddle, you sell, you do spreads, excuse me, you can do that on your own. So I just want to make it clear that my service, nothing to do with you guys, I'm talking to people who are new to our service, that you can devise your own option strategies based on my forecast. So what Corey just talked about is a brilliant strategy. You sell that, you keep the premium, it doesn't get there, you just basically, you just earn income. You can do covered calls on stocks. You can sell covered, you can sell calls. And basically, or you sell puts in order to hedge your position. Generally, the larger your position, this is what I find, then you want to use more option strategies. On a smaller position, you can do a little bit, and Thinkorswim gives you all those strategies right there. Whether you want to do a vertical, whether you want to do a straight, diagonal, you want to do a straddle, you just drop your order thing. It tells you, it'll tell you exactly how much it's going to cost you. So you figure out what you want to do. So you don't even have to sit there with pen and paper like the old days and figure out, okay, here's a butterfly, spread and all that stuff. Thinkorswim, at least, and a lot of other platforms, I think all of them do. They already give you those strategies right there. So you can just basically say, okay, it's going to cost me $2,000 doing this. It's going to cost me $500 doing it. I'm okay with it. So that's, so saying all that, guys, I got to wrap up. It's 1:45. Happy Columbus Day to everyone. And I'll see you guys tomorrow. And let's have a fantastic week. And I mean it. Having you guys around, keeping me focused on what I'm doing and everything, it's a great feeling. Spread the word out there. We're getting a lot of new flow of people coming in. And God bless you all. All right?
Thank you, Frank.
Anytime. See you guys tomorrow. Thank you.
All right. Bye-bye.
Bye-bye.
Thank